Just to introduce Andrew, after spending 2 decades, that must mean Andrew is older than 25. In the general insurance industry, Andrew joined Cutcher Neale in June 2021, and together we formed IMED. Andrew's got a wealth of experience, and I think I've cut him down to 15 minutes in this presentation, or 20 minutes. I think the big thing here is have a listen to what he's got to say, because not all insurance policies are equal, and there is a big difference in what you're getting covered and what you're paying for. Sometimes you can end up paying less and covering more, and that's certainly the value proposition from Andrew's perspective. With that, I'll hand you over to Andrew to take you on the journey through general insurances and medical indemnity.
There we go.
Okay.
Much better.
Just try your slide transition.
There we go.
Excellent. Thanks, Andrew.
No worries. So yeah, just saying that I've spent the last 7 or 8 years dealing specifically with medical indemnity insurance, and the insurances that go along with that, whether it be the practice insurance or the general business insurance that I'm here to speak about today. And it's basically today it's a in a nutshell type of presentation to get everyone thinking about what their future insurance should look like as they work their way through their medical career. Probably one of the points I'd like to make first up is, and one of the good things about using an insurance expert is they can give you personal advice, and you often hear it on all the ads in the on television about seek personal advice, or we offer general advice only, and that's a big thing. If you get general advice, whoever you're getting it from is not giving you advice based on your individual circumstances. They're giving you advice on the products they offer and not really taking into consideration what you do as an individual. So that's a really key point that I want everyone to leave with today. That personal advice, even though it's a business insurance product, that personal advice is key. So as I work through the different types of insurances that you should be considering, the first one I'd like to speak about is medical indemnity insurance. So basically, if you want to practice medicine in Australia, you must have your individual medical indemnity insurance. So if you're in private practice, that means you need a policy with one of the 5 medical indemnity providers, being Avant, Tego, MBA National, MIPS, or MIGA. If you're not in private practice and you're in the public health sector, chances are you're indemnified by your employee. In New South Wales, it's the TMF. And so within that employment contract, there should be an indemnity clause which talks about how they will indemnify you for your work as an employee for those organisations. So what is medical indemnity? So basically it protects the doctor from any legal action in the provision of healthcare. So if you're giving advice or performing procedures and something goes wrong and someone takes action against you, it'll provide cover for your legal costs, which we all know can escalate very quickly. If there's compensation to be paid at the end of it, the policy should respond there. And there's also non-legal fees they provide, like medical board and coronial inquiries. And I know a lot of doctors that we deal with often say, the checks and balances that they have to adhere to are many, but people can make a complaint and they're duty bound to respond to it. And even responding to those complaints can be time consuming and an expensive exercise. So with your medical indemnity insurance, what's it costs? And that's a how long's a piece of string type of question. So the rating factors the insurers would look at is what's your specialty. Obviously, if you're a neurosurgeon, it's going to be a lot more than if you're a general practitioner. The billing, so if you're doing a high level of billings, the risk according to the insurers is a lot more than if you're just doing, a starting level. Your location, because the claims data shows that, the likelihood of a claim and the size of claims vary depending on geographic location. And of course, if you're having lots of claims, the insurers will they will look at that unfavorably and load your premium accordingly. Years of practice I left to the last. So this is a bit of a strange one, because medical indemnity insurance is what they call a claims made policy. So when you think of who you're insured with when the claim gets first notified, that's who handles it. So your home and contents policy is an occurrence wording. So if your house burns down on the 1st of January, whoever you're insured with on the 1st of January insures you, covers that claim. You can move insurer on the 2nd of January, but your previous insurer is still responsible for that claim. With a claims made wording, and obviously with medical practitioners, you could do a procedure on the 1st of January and move insurers 6 months later, but a claim mightn't rear its ugly head for a year later. And it's whoever you're insured with when that claim is first notified that handles that claim, even if you're insured with someone else when the claim occurred. So that's why it's very important to understand your retroactive cover and your runoff cover. So your retroactive cover pretty much means you've got cover in place from that date moving forward. So for those of you who already have an indemnity policy, there should be a retroactive date. Some of the insurers now are moving towards an unlimited, so they'll just put unlimited retro cover on your policy. Some still have a specific date. So, but if you ever switch insurers, it's very important to maintain that retroactive date. And alternatively, when you retire, you need runoff cover, because you could stop working. It doesn't mean your exposure stops. If you retire for argument's sake or stop practice for any other reason, you could still have that claim that comes up 2 years down the track. And yeah, so you still need cover in place. There are a lot of government schemes, which is probably a bit above the scope here today, but as always, happy to take any questions over and above that, either at the end of the presentation or offline at a later date. So practice insurance, that's basically, when I say practice insurance, that's relating to medical indemnity insurance for the business entity and the staff that it employs. Other names it goes by is med mal insurance, entity insurance, healthcare company insurance. So depending on the insurer, it could be called a number of different things. And I'm sure you've learned today about how to structure your practice to maximize your earnings. And that's a good thing, but keep in mind with different structures, it has different effects on your insurance. And once again, it's pays to get that personal advice just to review what your structure is and what the ramifications are. We all know that traditionally, we had the doctor working out of the, a room in their house, and it was the individual and it was Dr. Smith, and that was their business. These days we see corporate entities and corporate healthcare sneaking in, where it's no doctors mightn't even own the practice, and we get the contracting doctors come in to do all the work. And that they're the situations where the practice cover really is required, because that practice insurance, that protects the staff and the business entity. So forgive me here, I'm just going to read, and these are from a policy wording from one of the medical defence organisations, and it just shows you how simple words and changes in structure can affect the insurance cover. So the definition of an insured under an individual indemnity policy here is the healthcare professional named as the insured on the policy schedule. And if the insured is a sole practitioner, and that's very important, which means if they're the only doctor, and wholly or jointly owns the corporate entity with a spouse or a person that does not provide healthcare at or involved in the daily operation of the practice, or a trust which they are beneficiary of, then the insured's practice entity also. And over on the right, we see what the definition is of the practice entity. But the main thing, reason I put that up is, if you're a sole practitioner, generally your individual indemnity will extend to cover your business entity as well. And that's, what are the repercussions? If you're not that sole practitioner and you've got a number of doctors working in a practice, chances are, and once again, this is just general advice, chances are that there will be an exposure to the practice entity and your staff members there. So the scary stuff, a real life case. Some of you may or may not heard of this. It's one of the more well-known cases, but this was a real life GP practice, the Bondi Junction Medical Centre, which was owned by one of those corporate entities, Idomeneo. So a patient came in and saw a doctor who was a contractor, but before they saw the doctor, the reception staff didn't confirm the patient's address or contact details. Patient had a blood test, was inconclusive, and the practice couldn't get in contact with the patient again to say, listen, we need you to come back in for another test. They did come back in under their own steam a little bit down the road, but unfortunately saw a different doctor that didn't read the notes properly, and the fact that they needed another test was missed, that they were advised that everything was clear, and they went home and had unprotected sex with their partner, who was unfortunately infected with HIV. So that was a situation that could happen, or did happen. So what was the claim? The partner of the patient sued the doctors. So between the doctors and their own individual indemnity insurer, they accepted liability, but Ida Menio, the corporate entity, didn't. They refused indemnity in this case. However, the doctors' medical indemnity insurers made a cross-claim against Ida Menio, seeking contribution towards the damages that they paid. And just on that, that's what they call subrogation. So basically, in nearly every insurance policy wording, you give away the right for the insurer to pursue costs against a third party. So even if you didn't want to do it under the insurance contract that you've entered into, that insurer has the right to go after a third party to recoup costs. So what was the outcome? So the courts had to decide if a duty of care was owed, which it was deemed there was, because the staff had manuals saying they need to check sort of patient records, they need to maintain the records. So with that in evidence, the court was, simply decided that yes, there was a duty of care owed by Ida Menio and the staff members there, and in this case it was breached. So the ramifications of that, the business entity was ordered to contribute 40%, which equated to $360,000. So that was just one example of where a medical malpractice business entity case of insurance was really required. Especially in these days and this day and age where you've got people, providing syringes, the business entity would be providing all types of equipment. So if they fail, that falls to the business, not the individual. So as we move on, and I'm just wary of time, so forgive me, business insurance is the more traditional insurance covers that you're probably used to. So these come back to that occurrence wording. So whoever you're insured with when it happens. So business insurance would probably suit 95% of medical practice. And it's a package product. So there's, depends once again on the insurer. It could be 11, 12 sections in that policy, and they include your property. Cover against fire, flood, those type of risks, public liabilities. So that protects, your slip and falls. Business interruption. So that's basically protecting your revenue if, for argument's sake, your premise is burnt down. Business interruption keeps your revenue coming in. You can claim for that. Glass cover and theft. So pretty self-explanatory cover if there's any glass breakage or you get robbed, and money cover if you still have money on premises. And then depending on what type of business you run, electronic and portable equipment, places like radiology practices, that's definitely something that they should consider moving forward. So once again, what's that cost? That's another how long's a piece of string question, but the construction type, whether it's an old wood building or a modern brick building, totally different. The sums insured obviously affect the premium, and the type of protection you have in place, your fire, whether there's sprinklers involved or whether there's just smoke alarms, that all affects the premium. And just in point here, if you enter into a lease agreement, generally, once again, there's an indemnity clause. So that says that you're responsible for the liability, probably glass. These are common sections that as a lessor, you're required to carry out, and it's generally glass and public liability as a minimum. Cyber insurance, I won't go too much into depth here because Eddie was quite in depth with what he had, but I will mirror what he said. Healthcare is very highly targeted. And I guess he spoke about what assistance is available out in the market. The good news is you can insure that. You don't have to pay for it all up front. You can take out the cyber insurance policy, and it's that covers the forensic IT costs. He spoke about the OIAC, I'll make sure I get those right, notifying affected customers if there are a breach. You're required to do that under law. Any restoration costs, worst case scenario, a hacker locks up your system and deletes the whole thing. It can cost a pretty penny to restore everything you've got. Business interruption is available as well from a cyber incident. So if someone hacks your systems and you can't get access and you can't work for an extended period, then once again, you can insure your revenue to make sure that's still coming in. So it is there. But what I tell my clients, and what I think the most important thing is, my advice is to pay the premium just to get a phone number to call the experts. You know, you get a 24 hours a day, 7 days a week rapid response team that are IT experts, that if you can say, I've come into my practice, the systems are locked up, I'm getting ransomware messages, you call that number and they can pick it up and run with it, and it just eases the stress. A real life example as well, it does happen. On the Gold Coast, Russian hackers held a GP clinic to ransom. Yep, it was a ransomware attack. So they encrypted the practice's database and only wanted $4,000. And that sometimes is a common, they only ask for a low amount because in their mind, the likelihood of payment goes up. Unfortunately for us, they try and keep it a secret whether these ransoms are paid, because they don't want to advertise the fact that they can be paid, and it might embolden any hackers to keep going with the hacks. But rumor is that one was paid just to get access back. So yeah, once again, to have that rapid response team, they could have called them, got the expert advice, they could have had an attempt to recover the data themselves, and when it wasn't available, the insurance policy could have paid that $4,000 on their behalf anyway. The final insurance policy that you should consider is a management liability policy, and it's a wrongful acts policy. So it is a rather broad policy in terms of what's defined as a wrongful act, but claims can be brought from various sources, as you can see there, the various regulators, if you breach any legislation, etc., employees, competitors, if they think you're dealing or making deals that are could be considered wrongful. What's an example? Undercutting or false or misleading advertising, that would be an example of where competitors could make a complaint. Customers or suppliers that could claim that, as an example, you're cutting them out of the market, or charging or not paying a fair price for where you're getting your equipment, etc. And obviously shareholders can take action against any directors. So the sections within that, directors and officers, which once again is the main policy section where they cover any wrongful acts by any managers in the policy. Employment practices liability, so that's where it can cover anything from bullying and harassment claims to unfair dismissal, crime. So if you have any of your staff members siphoning money out, there is a cover there. Statutory liability, that's for argument's sake, if you have any OH&S or workplace health and safety or environmental claims made against you, the policy can respond to those as well. And also tax audits if you get any action from the ATO. My apologies there, I sort of rushed through the last couple of slides. That's just a general disclaimer that it's all general information. But I think that's well and truly my time, but happy to take questions.
Thanks, Andrew. Great
Nice.
presentation. A lot to get through in a very short period of time.
Yeah, my apologies on that, everyone, but happy to take questions, as I said, here or offline later at a later date.
Okay, so I do have two questions, if we could ask them of you. I've been with my provider since training days and I'm getting discounts. Is it worth having a review?
Definitely. When you say getting discounts, I'd imagine you're referring to the starting in private practice. As you come to the end of that, my advice is it's the perfect time to try it, because at the moment you're getting a discounted rate, and each of the insurers offer their discounted rates for the first few years. At the end of that, that's when you're going to see what their mature rate is. So that gives you a really good idea what your premium would be moving forward into the future. And yeah, so always worth shopping around. Okay,
and then just one other question, Andrew, if you don't mind. Will my staff be covered under my own doctor's medical indemnity insurance?
Comes down to the business structure. As I said earlier on, if there's only one doctor working there and the ownership structure is basically the doctor and the doctor's spouse, and the staff is not providing medical services in their own right or billing for those services separate to the business, generally yes. However, if there's more than one doctor in the practice, then generally no, the staff would not be covered.
So my takeaway from that is you probably need additional insurance.
Yeah.
All right. Well, thank you very much, Andrew. Thanks for the insight and those live case studies as well. We'll now move on to the last presentation. So our tail ender, Brad Oldham, Brad Oldham is Cutcher Neale's in-house risk insurance specialist. He works predominantly with our medical clients, assessing their personal financial risks should they become ill, injured, or die, and recommends and implements appropriate policies. I think the key to Brad's advice that I've experienced is it's understanding how the policies apply and then what level of coverage you need and how you scale that coverage for your particular circumstances. And today, often overlooked is income protection. I did talk about workers' comp insurance in my presentation. It's not really insurance. So, those policies become very important. And if you're in a group practice, then cross insurance is going to be very, very important. So with that, I'll pass you over to Brad for his presentation.
Thanks, Jared, and welcome everyone. Been a long day, no doubt, so I'll try and keep this as relevant as possible for you. Initially, I just want to touch on what these personal risk insurances are that we might normally discuss with our clients, and that whether that's medical clients or otherwise. The typical ones that we look at, critical illness insurance, which is often referred to as trauma insurance. That's a lump sum payment. It requires the diagnosis of a critical illness. The premiums are not tax deductible, but the payment is also not taxable. Income protection insurance, I'm going to touch on that in a bit more detail in a moment, but basically it's a monthly payment. It is assessable income, a bit like your income is at the moment, or a lot like your income is at the moment. Replaces a portion of your salary. Again, I'll touch on that in a minute. Tax deductible premiums, and you can also add in things like what they call a needle stick benefit, which are for airborne diseases that medicos may get. Total and permanent disability cover. It's again a lump sum payment, and I think with one of the keys with this sort of thing and income protection is that the devil is in the detail with regards to the definitions. So when we look at total and permanent disability cover in particular for our clients, we're trying to get the most relevant definition. The only point in having this insurance is having yourself in the best position at claim time, and that's why there's some are better than others, and that's just a reality with insurance, like a lot of things in life. Life cover is pretty straightforward. It's a fairly defined event, but we need to assess what sort of financial outcomes are required to mitigate the risks, the financial risks that anyone might have if they happen to pass away. There are also some business risk insurances that we look at. Now, remember with all of this, this is all sitting around the life insured. So it's the individual's health. That's what this stuff is, as opposed to some of the, or a lot of the insurances that Andrew would have been covering off in the previous presentation. So they're quite different. So business expense insurance typically is a monthly payment. It's assessable income, tax deductible premiums. I'll go into the business expense insurance a little bit more detail as well. Key person insurance is actually both life insurance and TPD insurance, but just sort of badged a different way with a different relevance. So that may or may not be relevant to individuals within a practice, or in fact, in a lot of businesses. And then, as Jared's alluded to earlier, the various buy-sell cover, the unit holder insurances, lump sum payments, they're pretty important to make sure that if something happens that you can transition out of a business appropriately, at least from a financial perspective. So income protection, the basics. It replaces your earnings by personal exertion. So it's important to know that that's got nothing to do with passive income, although that definition has changed recently. So there is an aspect of passive income, but under a certain threshold, it isn't taken into consideration at claim time. It's obviously based on the illness or the injury while someone is under medical supervision. The figures there that I've put of paying between 68 and 80% of earnings looks like a fair sort of difference. There are some changes that have occurred, which I'll go into in the next slide, that just happened on the 1st of October this year, which were quite significant, and they're all targeted around income protection. So right now, the policies that you can get can pay 60 to 70%. In the past, you used to be able to get policies that might pay 80 and even 85% of earnings. And for high income earners, there's another calculation that comes into play, so that does vary as well. They're a monthly payment and they're paid after a waiting period, so they're paid in arrears. That's the benefit. So the key there is understanding how long you could financially sustain yourself without an income, to push that waiting period out, for instance, as long as possible, because the longer the waiting period, arguably the cheaper the premium. The benefit is paid as assessable income, as I mentioned earlier. So yes, you will be taxed on that as you are on your current income. But the premium that you pay is tax deductible at your marginal rate if it's personally owned. And typically our advice or general structures that we set up with these sorts of things is that income protection would be personally owned. So I mentioned that some changes from 1st of October. The important thing just to let you know up front is if you already have income protection policies prior to the 1st of October, they are what they call guaranteed renewable. So I will qualify that as long as you've got those through a retail insurer, which you will typically get through a financial planner or a broker. So the retail policies that were issued before the 1st of October are not affected by these changes from the 1st of October. The definitions, as I mentioned before, are pretty key to this. And I'm pretty sure that Jared might have touched on this earlier around the own occupation definition, as opposed to the any occupation definition. Now, all of this doesn't mean you can't or won't get paid if you have the any occupation definition. It's just there's a lot more certainty around the own occupation definition, because that's based on the important income producing duties at the time of disability. The any occupation is if by way of education, training or experience, you can undertake another role, that might be a reason for you not to receive the benefit payable. So as I said earlier, you want to be in the best possible position to claim if you're going to bother getting this type of insurance, which I clearly recommend you do. One of the things that's also changed now, they're using what they call a duties-based definition. I won't go in, well, it's effectively the duties of your role, but they did have another couple of definitions which used to come into play. So they were time and income. So it's a little bit more restricted now. The income replacement ratios, right down to as low as 60%. And prior to this, it used to be 75% plus your super guarantee. So the concern that we probably have there is obviously that replacement income for people has changed, and there are some strategies around that which might be worthwhile having a think about or asking someone about. So what I've alluded to there on that last point is it raises the importance of TPD as a supporting policy for income purposes. So if we go back to point number two, previous points on the previous page, you can get paid 70% now for the first 2 years, but then only 60% typically from that point on. And also the definition changes from the own occupation to the any occupation definition. So the concern there we might have for a doctor, for instance, is that perhaps the consideration might be at that 2-year period that they could become a university lecturer. And that may be a reason that the insurance may not continue if they're on a long-term income protection claim. But it's important that we have a look at those strategies around mitigating that. These are the most significant changes to personal risk insurance in probably the last 25 years that came into effect on the 1st of October. So where do you get insurance? There's group insurance and retail policies. Retail policies are the ones that I typically would work with and most financial advisors. Group policies are the ones that you might see in your industry super fund. So Hester or Aware Super or whichever one it might be. And typically you get a default TPD and death benefit, sometimes some income protection. They're designed for the average worker. They are very limited. Their definitions are comparatively poor. They're owned by the trustee of the super fund. So they can change the rules, and they have, and they do. Every 5 years, they can rewrite those rules. I have seen with one of them where they actually introduced a retraining component. So if they could retrain you, I don't know, perhaps you've got a driver's license like we all do, and you might be able to drive a cab or an Uber. That's probably a bit extreme, but at the end of the day, they've got a clause in there which might be a reason that they don't pay you. Direct insurance, I Select insurance line, those sorts of things. Really, they are what they are. They're there for people who want a quick, easy solution, but I do know that the definitions held within are very limiting. Things like mental health exclusions, for instance, and as I'll show you on a slide later on, mental health is the highest claim for income protection. So there's a reason that they have those exclusions, because they don't want to pay. Retail insurers are the ones that any qualified financial advisor or risk insurance specialist would be working with you on. So the top tier insurance companies, there are 10 at the moment, about to become 9 because one's being swallowed up. They clearly offer the best options for our clients, and I would suggest most people, so that if you are in that position of claim, then you're perhaps hopefully in the best position. The key there is it is tailored advice, and they're only available through independent financial advisors. There are some other ones out there that are available that doctors may well have seen. However, the bottom line with this is you do need to speak to someone about what your actual needs are to try and make sure you get the right stuff in place. The basics of business expense cover. Now this, for someone entering private practice, is probably, generalising here, but probably unlikely to be required first up. Income protection insurance, more likely. Business expense cover is based on the operations of the business and the fixed cost. It's actually tied in, if you like, with a claim or a reason that you may claim for your income protection type of cover, because it's the same sickness or injury that's applying to that individual. But it covers the fixed business costs in the business, and it's separate to income protection. And this is really important. Your income protection is there to pay for your own personal needs, your mortgage, your food, your living expenses. The business expense cover is there specifically to cover off those costs in the business. And if you don't have it, there's a potential that you might need to kick into your income protection cover to make sure that everything's going all right in the business if you're unable to work. Typically, they assess the last couple of years' financials, which is one of the reasons it's hard to apply for a startup business of any type, because you don't typically have that information, although I have had some exceptions where we've been able to put something in place depending on the individuals and what their previous working history was. For instance, I had a couple of ophthalmologists who were sole traders prior to joining in a practice, and we were able to put a case forward to get some business expense cover based on their previous 2 years worth of earnings. So there are some exceptions, but again, there's absolutely no way that anyone is going to get that by going direct to an insurer unless you've got someone to sort of bat for you, someone like myself or others. The claims are assessed on financials at the time of disability. They are monthly payments similar to income protection, but business expense cover normally falls out after about 12 months. And the purpose there is that if the individual is still unable to work towards that period of time, then it's more likely that they're probably unable to work again in their particular field. So they have a 12-month situation where basically it gives them either the ability to wind down the business or perhaps get someone else to come in and take it over. So the benefits are accessible income, and the premiums are tax deductible, as I mentioned earlier. There's a list here. I won't go too heavily into that, as some of the eligible expenses that are in there. Down towards the bottom there, it says salary and wages and super. So that's for non-income earning staff only, not for doctors that work within the business. But interestingly enough, one of the things you can do is get a locum into the business to cover off your needs, and business expense insurance can arguably cover that. The claim statistics that I was talking about earlier, the female top 5, number 1, unfortunately, mental health. Number 1 for men, unfortunately, mental health. And then obviously a range of other bits and pieces coming through. Cancer always features, unfortunately. So that's this is fairly recent. This is from AIA. And so I think that's roughly 12 months old, that particular set of statistics. So the key points and the top key point for me is if you haven't already started in private practice, and if you are still working under a salaried arrangement, whether that's in the hospital system or even perhaps if you're a sole trader and have a history of income, my strong suggestion is to get income protection in place now, because you may find it difficult to justify that income, which is what the insurance companies want to understand, how much you're earning so they can know how much they need to insure you for. So I've seen this quite a few times when someone has been referred to me within Cutcher Neale, a new client or a client of the firm, and we look to get obviously the best outcome we can with regards to how much income protection insurance, but it's sometimes very difficult because of the lack of financial history. So that's probably my number one point if you're in that position at the moment. As I mentioned before, policy definitions, the devil is certainly in the detail. Ownership structure is really, really important. Income protection, quite often fairly simple, personally owned. One of the keys with insurance is whoever owns the policy receives the benefit payable. It's a really important thing to know. And for that reason, where we would recommend that something is personally owned, like income protection, that means there's no requirement to have it released from superannuation, for instance, where you may not meet a condition of release if it's a policy that's owned inside of super. If your situations are applicable, then it's worthwhile getting your service trust agreements in place and include a contingency for illness and death. The other most important thing is bother to get professional tailored insurance advice. I don't know how many clients I've reviewed that have come to us that have either put something together themselves or perhaps had advice from someone who's not really focused on this insurance side of financial planning, which is what our division does. We have 6 staff who just work on personal risk insurance. So we do know what we're talking about with this. And my very strong suggestion is if you're going to bother with this, once again, you want the best outcome at the end if you have to claim. That said, I hope you waste all that money and never have to claim because you're never sick. But if you are, we want to be able to help you get through that. The other part with a financial planner or someone along the lines of myself is at claims time, that's another part of our role to help process that claim, go into bat if we don't think it's going well or appropriately, and be on your side to make sure that you can focus on getting well as opposed to worrying about money. That's pretty much it for me. Thank you very much. I'm not sure if there's any questions that are coming through or otherwise.
No, that was a great presentation, Brad. Thank you, and finished it off strong. We actually do have some questions. First one for you, Brad, is what's the maximum income per month you can receive for income protection?
That's changed from the first of, well, actually, the highest amount you can get is $60,000 a month, but there's some pretty serious requirements in that. Most of the new policies that have been rolled out just, from the beginning of this month, which a lot of people like us are still critiquing and deciding on which ones are the best in the market. Most of them has a limit on $30,000 a month, and that would be the equivalent based on the way it's calculated. So it's not based straight up on that 60 or 70%. There's a variation to this particular theme. So that would be based on an insurable income of $560,000. To get $60,000 a month, you used to have to earn, I think it was about 2.13 million or something.
Yeah, certainly lots changing. There is another question.
Yep.
Why is my level premium policy monthly payments going up so rapidly, 50% over a few years? I thought they were supposed to be level and so stay rather flat than the stepped ones, which increase.
That's a really good question. And that idea of a level premium structure for any advisor who has worked with a client would always, up until, I could tell you, up until about 4 months ago, we recommended that in our business for pretty much everyone who had income protection insurance, because as you've just indicated, it should stay relatively flat. So one of the reasons that hasn't is based on the amount of money that has been lost in the income protection sphere within the Australian insurance market. So the changes that I've talked about from the 1st of October have all come, specifically around income protection insurance, have all come due to APRA, the Australian Prudential Regulatory Authority, who came into the insurance industry about 2 years ago and hit them with a big stick because they'd lost somewhere around about $3.5 billion in the preceding 5 years. And the reason that money had been lost is each of the insurance companies had built these products with more and more and more add-ins, which makes it easier for people to claim. The other side of that is the financial markets, which is where they've invested the premiums that you've paid them, have been, somewhat poor for quite a few years. So they've had this double whammy of significant claims and a lot more claims in the mental health sphere, for instance, and also poor returns on their investments. The only way that they can keep their products sustainable was to increase the premiums. So 50% over, say, the last 2 years would probably be towards the top end, but certainly not the highest. Highest I've seen is 72.5%, and that is on a level premium structure. It's a really difficult conversation for people like myself to have with clients, because the background to it was always to make that the most cost-effective way to have a long-term insurance policy. And it hasn't played out that way, unfortunately, not to do with the advisor, I would have to say, more to do with the way the insurance industry's played out. We currently recommend a step premium. And I guess the takeaway from that, Stuart, is it's probably worthwhile having a chat to someone about your current policies. There are other policies out there. There'd be a fair comparison to make now that these new ones are in play. We'd have to be very careful about what we recommended, but it might be worthwhile looking at what strategies are available to make them more cost effective. And there are some ways to do that. I've recommended a number of strategies to clients at the moment to make that level premium a little more effective for them.
Yeah, and that theme of checking in regularly has also come through Andrew's presentation as well. Thank you very much, Brad.
My pleasure.
Ladies and gents, that brings us to the end of today's jam-packed program. Thank you for your attendance. It's been a lot to absorb, and we look forward to seeing you next time. Thank you very much.